Hi, I'm Lauren Basmadjian, and I'm the co-head of Carlyle's liquid credit business, which represents about half of the assets under management within Carlyle's global credit platform. I've been in the liquid credit business since 2001, starting at a boutique asset manager. When I graduated college, I joined Chase right after they merged with JP Morgan, and there was a division within the bank that managed bank loans, and that's where I joined. At that point, the CLO market was very small. It only had started in the late 90s. But as banks looked to shrink their balance sheets and hold less bank loans, the CLO market grew and really took the place of banks. Today, the CLO market is over $1 trillion globally. I joined Carlyle last June. Though Carlyle issued its first CLO in 1999, today we manage about 40 US CLOs on behalf of Carlyle investors. Bank loans were really in its nascency, where banks would extend credit to borrowers and hold it on balance sheet. But as banks looked to shrink their balance sheets, there became a need for alternative asset managers to step in and provide credit to below investment grade corporate credit. In high yield, you saw that come more from retail accounts, but in bank loans, you saw it really come from CLOs. So if a below investment grade company needed money for an acquisition or an LBO, CapEx, dividends, they would go to a bank to underwrite the credit, and the bank would syndicate the bank loans out to borrower or to the lenders like CLOs. The bank loan and the CLO market did quite well during COVID. It was really the second critical stress test that our industry was put through. In the beginning of COVID, it was very unclear what that meant for our borrowers, and many predicted significant default rates and perhaps even systemic risk from below investment grade corporate credit. But what happened was defaults peaked at about 4.3%, and now we're already back to 1.5%. It was generally companies that were already in poor financial position that went bankrupt. And many of those that survived used COVID as an opportunity to reduce their costs significantly. So today we're seeing our portfolio companies' margins higher than they were pre-COVID in most industries. And though sales and EBITDA are down versus 2019, if you exclude the industries that were hardest hit by COVID, like travel, leisure, and entertainment, we're actually seeing both sales and EBITDA expansion as companies took out a lot of costs. Well, it's been an extremely busy year thus far at Carlyle. Last year, we took the COVID opportunity as a way to look at our credits, re-underwrite the credit risk, and we expressed our view by trading about $11 billion in US liquid loans to try to position the portfolios to withstand whatever the outcome of COVID was, whether there'd be a vaccine that worked, whether it took a while to roll out, or whether we came out of COVID quickly. Because of the performance of CLOs in general, 2021 is likely to be a record year of CLO issuance. There's been a lot more investor demand for floating rate product, which is bank loans and CLO tranches. And because of how well the product has once again performed, as well as the health of the underlying borrowers and the floating rate nature in a rising rate environment, there's just been an immense amount of demand. I think we may see CLOs have a record issuance year this year. There does not seem to be a lot of stress in the below investment grade credit market right now. Because the sticker companies already filed for bankruptcy, we are seeing very low default rates right now. And we're actually seeing 2 times the amount of upgrades to downgrades year to date. 1% of loans are trading under 80. Historically, that's really a low amount. Even the CCC index is trading about 10 points higher than it normally does. I think all of that together with how well below investment grade corporate credit companies are performing, and the fact that they're growing sales, they're growing margins, they're growing EBITDA, so they're deleveraging again, and even using cash on balance sheet to pay back some of the debt that they took out during COVID, that sets up for a pretty benign credit environment. When you think about us getting paid actually higher on a spread basis today than we were getting paid pre-COVID, I think that sets the loan asset class up for more demand in the future. There are quite a number of very senior women in bank loans and CLOs, both on the management side and the investment banking side. So much so that the Wall Street Journal put out an article a few years back highlighting our industry as an outlier in that there are more women portfolio managers than other asset classes. I think that there were a number of women in credit in the late 90s that worked at banks. It may not have been the headline investment banking job that some men were striving for, but those women had the right experience to eventually go out and run large credit shops or a lot of credit AUM, given their background in underwriting credit in the 90s. I'd say having women in senior visible risk-taking roles helps to attract more female talent. It's self-perpetuating in that it's easier to picture yourself growing up in an organization and getting to an important position when you eventually go out and achieve that in the past. I'm biased, but I would encourage women to explore careers in private credit. It's a growing market that provides opportunity for an intellectual and professional growth. From a career perspective, I would say don't be afraid to speak up, voice your opinion, and be assertive, not arrogant. Do your research and know your audience.